Good evening. Welcome to this evening's Westport Library Business Program, Restoring a Healthy Economy, the Current State of COVID-19. I'm Ellen Jempel, Business Librarian, and our speaker this evening is Julina Ogilvie, CIMA, which is Certified Investment Management Analyst, CPWA, Certified Private Wealth Advisor, Partner and Wealth Advisor at Principal Wealth Partners in Westport. Julina manages wealth for high net worth individuals and families, in addition to guiding successful advisors through the firm's succession planning strategy. She has held executive roles at J.P.Morgan Asset Management and Lord Abbett and Companies. In these roles, she used her extensive knowledge of capital markets to educate the country's top advisors. She is an accomplished speaker and strategist who has presented wealth management concepts to thousands of financial professionals and clients. She is recognized for her outstanding achievements and serves as a mentor for young women entering the business. A graduate of Colgate University, she is an avid skier and triathlete and lives with her family in Fairfield. Let's give a good welcome to Julina Ogilvie. Thank you. Just before, I just want to say, please hold your questions till the end of the program, and if you have questions, please enter them in the chat room. Thank you.
Great. Thank you, Ellen, so much, and for inviting me, and for everyone that is attending tonight. I'm sure that the concept of being on a Zoom is not as enticing as it was back in March, so I'm hoping that this is an important topic that you're interested in and that you have some knowledge of some information coming out of this. I am going to share my screen, and Ellen, you let me know if you can see the slides in front.
Yes.
Okay, great. So the title here tonight is Restoring a Healthy Economy, and what I thought I would do is, given all of the conversations that we're having with our clients right now, they're really coming down into these, into 6 key areas that I thought I would spend some time on. So let me quickly review what my agenda is for the evening. And I'm hoping to do this in about 40 minutes tops, and then leave some time for questions. The first is obviously an update on where we are with the pandemic. The second is a discussion around the economic recession that we entered and where we might be from here. I want to talk about the markets and all of the emotions that have been created from it, where we see uncertainty going forward. And then there's a little bit of a discussion around what we call this new world, fatter future. We've seen so many trends over the last 6 months transpire. And I want to talk about some of these that we think might be longer term versus just short-term fads. And then finally, where we see some opportunities, this will lean a little bit more towards the financial aspect, but we want to talk about some areas there as well. So I'm going to start talking about the pandemic. It's amazing to think that when we began this 6 months ago, we had a forecast from scientists of 15 days that we needed to slow the spread. And at the time, the idea of 2 weeks just seemed so long, and yet this, of course, has not been the case. Governments globally began the difficult trade-off between public and economic health. Despite over 80% of the COVID cases as being mild or asymptomatic, we shut down 95% of our economy. As you can see here in the blue, this indicates the new cases, their 7-day moving averages, which peaked in the summer at 66,000 as we reopen the economy. This uptick appears to be both a combination of the increase in socialization, but also in testing, which increased by almost 6-fold. The 7-day moving average of deaths is indicated in the orange. That also ticked up this summer. And although both have leveled off, there is obviously a concern of a second wave. If you look at what we're finding in Europe right now in their numbers, here we've got flu season approaching, kids are going back to school, they're playing sports. And certainly all of that adds a concern. The data today indicates that 80% of those affected by the pandemic are over the age of 65, and 40% of the cases are coming directly from nursing homes. In reality, there is no life as normal until a vaccine is distributed. And this appears to be what will drive our recovery and what that path of the recovery will look like. We've seen an unprecedented response from both fiscal and monetary policy. On the fiscal side, most notable was the CARES Act in March and the Paycheck Protection Program, which is known as PPP, which is primarily for individuals, small and large businesses, and municipalities. The stimulus so far totals $3 trillion, predominantly to businesses and unemployment, which are on the top as you move clockwise, to the Federal Reserve, which I'll address in a moment, to healthcare, municipalities, airlines, education, and disaster assistance. All of this stimulus today represents about 20% of our overall economy as we measure it by GDP or gross domestic product. And suggestions of further stimulus of about 1.8 trillion are currently being discussed. I'd like to spend a moment on the monetary policy. As you can see here, the Federal Reserve has also expanded their balance sheet. In just a 6-month period, they ballooned from 4.2 trillion to over 7 trillion. And notice how this compares to the first 3, what we call QE, or quantitative easing, which occurred over a 4-year period following the Great Financial Crisis. And that's indicated in the white box at the top of the page. The current pace is about 125 billion a month, primarily of purchases of treasuries and agency mortgage-backed securities. Even more noticeable on this slide is the forecast of these purchases, which is to the right of the dotted line. They plan to continue this because they want to ensure that there's plenty of credit available to the marketplace. So this expansion is likely to continue. Let me go back one second. The Federal Reserve also launched or reopened 8 lending facilities to promote more than 2 trillion of loans to distressed corporations, municipalities, and money market funds primarily. The Fed has been very vocal of their forward guidance. They are saying it does not expect to raise rates for a period of time. In fact, not a single one of the 17 officials offering their forecast to what the industry knows as the dot plot thinks they will raise rates either this year or next. Now, it's interesting to note after the 2008-2009 crisis, the Fed didn't raise rates for another 6 years. All of these actions raise the longer-term issue of our nation's debt. Our debt to GDP, or gross domestic product, that ratio will cross 100% and surpass World War II numbers over the next couple of years. We've clearly borrowed from the future, and we are going to have to address this at some point. Current discussions around the economy appear to be all about the alphabet letters, meaning that the letter is going to indicate what that path of recovery will look like. The 3 most likely letters appear to be V, U, and W. The original forecast was led for a V-shape, indicating a quick recovery off the steep decline of the second quarter of this year. As many states have now paused or reversed reopening, there's discussions of what's known as a U-shape, meaning a slower bounce back off the bottom. A W-shape would indicate a second recession quickly following this one. The second quarter of GDP was released, down 31.7%. The Atlanta Fed has a tracking model, and they have a forecast for the third quarter of up 32%. Now, this is interesting because if we're down 32 and then up 32, one would think that we've made up all of what we lost. And unfortunately, that's not the case. It's what we call in the industry arithmetic of loss. You need a higher number to make up what you lost. And in this case, we need 46.4% to make up the loss in the second quarter that was down about 32. The path of the letter of this recovery will continue to be driven by health response from the states and will shift from this economic stimulus to the distribution of a vaccine. The recession has also been most notable in our unemployment. We began this year at a 50-year low and peaked in April at 14.7%. Unemployment has fallen to 8.4% in August, which I circled here. Most of that decline in the leisure and hospitality areas. I read this as a good sign, as most economists did not expect our unemployment back in an 8% range until well into next year. And then we have the markets. We had 11 years of a bull market. During that 11-year period, we posted a cumulative return of 401% on the S&P. That's not on this slide. This pandemic began the year with a market decline of 33.9, which we do indicate here in the black, as of March 23rd. This occurred in less than 1 month. A decline of this amount occurs on average over an 8-month period. So this was the fastest decline. We then proceeded to see a complete reversion in the second quarter. And in August, we reached new all-time highs again. We are at an interesting point when, if you compare to two other significant periods, 1929 is in orange, or 2009 is in green. You can't help but wonder if we repeat either of these scenarios. Now, the pessimists today would suggest that the rally was the markets getting ahead of themselves with all of the stimulus that was pumped into the system and the optimism that we had as states came out of quarantine this summer. With most, if not all, of the stimulus released, coupled with an increase in cases and concerns about further shutdowns, they don't believe that it's sustainable. The optimists, on the other hand, are looking at this longer term, and they're focused on areas such as economic data and corporate earnings that both appear to have bottomed in the second quarter of this year. Most likely, we're not going to fall on either of those lines, but more in between the two. But we are certain that along the way, we are going to see more emotion. Speaking of emotion, I'll share with you on this slide a couple things. This pandemic, although it resulted in one of the quickest equity rallies in history, we're again reminded how emotional we can be as consumers and investors, and to our detriment most times. Investors fled to safe haven assets during this pandemic, one being the US Treasury, which pushed yields below 1% for the first time in our history. And the second safe haven was cash. According to Fidelity, as you can see here, almost 20% of individuals sold their equity holdings, and that percentage was much higher for the older demographic in their 60s and above. In fact, the personal savings rate soared from 8% in February to 33% in April. All of this while money market rates plunged. In fact, the money market yields are now lower than the fees to manage the funds themselves. The Vanguard Money Market Fund is quoting a yield of 0.01%. This is a challenge, and this does not appear to be thoughtful decisions of individuals based on their long-term financial needs. To me, a subtle sign of a path to normalization is the media. If you think about their focus in March, it was absolutely nothing but the pandemic. Now to where we are today, we are talking about a lot of other stories: civil unrest, trade relations with China, which appear to be all about TikTok, the passing of a great woman, Ruth Bader Ginsburg, her reappointment to the Supreme Court, and of course we have an election. One of the more common indicators of volatility, which we show here, is the VIX. It wasn't long ago, in 2017, if you can see the blue dots trending towards the bottom, that we were at unprecedented lows in volatility. It was the first year ever that not a single month ended lower than where it started. Since then, levels have certainly trended higher, but in more recent months, they have been much more dramatic. And in fact, we are now surpassing peak levels of volatility that we witnessed in the late 90s. Not all volatility is bad, but we have to remind ourselves of an old analogy that if you've been flying on a plane with no seatbelt, it may be time to buckle in because we are expecting some more turbulence before we approach year end. So let's talk about some of that uncertainty. We could talk about a lot of them, but I'm going to highlight 3 of them. In the shorter term, we have this upcoming election. But over the longer term, a lot of what we talk about are issues like income and inflation. So let me address those 3. It is always a guarantee that the months approaching an election are full of opinion, predictions, emotions, and this one has absolutely been no different. In fact, a recent study showed that 93% surveyed believe that the president can influence the markets, the president in general, and that 45% of those individuals plan to make changes to their investments based on this upcoming election. Although the president may be one of many factors to influence a market, we would argue that it's not the strongest. As you can see here from this slide, if there's any correlation to a presidential term in the markets, it's that they go up over time, despite who's in office, whether it's a Republican or a Democrat. Now, statistically, from 1933 to 2019, the S&P has returned more when a Democrat was in office versus a Republican. However, if you dive into the math, almost all of this outperformance was explained from the boom years under Clinton and the subsequent dot-com bust and the global financial crisis under Bush. Where we have seen more subtle returns over time and deviations have more to do with a divided government versus a non-divided government. That has averaged about 1.6% better over the long term when it's been a non-divided government. One thing that may be different this time around are the requests for the mail-in ballots due to the pandemic. It is very likely that we will not have a victory declared from either side for days following November 3rd. If there's anything we've learned from elections, it's that you need to be prepared for extreme and unpredicted outcomes. As an example, it wasn't only as recent as 2016 that we witnessed an outcome that was not predicted by the polls. This is a good time, in our opinion, to check your investment portfolio to ensure that first, you are protected should an election turmoil unfold, but at the same time, you want to be positioned to benefit from a continued global recovery that we are expecting. I would summarize this by suggesting that the market returns are more dependent on the outlook of the economy than on the outcome of the election itself. The second challenge, of course, is income. Let's first look at this by the history on the left-hand side of the page. This shows 3 broad asset classes, starting on the far left with investment-grade corporates. These are BBB rated bonds and above, municipal bonds, and then treasuries. The light green bars show their yield 20 years ago to where we are today in the gold, and I put these fancy little arrows all indicating they're going down. As an example, the 10-year treasury 20 years ago paid you more than 6%, and today is at an unprecedented low. It's at 0.7%, less than 1, as of the beginning of September. As a reminder, bond market prices move higher as rates go down. With rates as low as they are today, there is a natural concern of what to expect of bonds going forward, given 2 things. One, so much of the past return on the bonds was driven by yields going down and you received an appreciation. And number 2, that when rates eventually do rise, this will create a negative price return in traditional bonds. Historically, you have a coupon on that bond to cushion some of that volatility. And as we just alluded to, there is no such cushion, unfortunately, today. Where retirees in past decades were able to rely on bonds for income and return, this will be more of a challenge going forward. We're not alone. This is also a global issue. If you look to the right, over 90% of global sovereign debt is providing today less than 1% in income. The third, which candidly has not been an issue for quite some time, is inflation. The recession combined with a collapse in oil prices triggered a decline in what was already a low inflationary environment. Today in the circle, you'll see where it's hard to see, I apologize. We're looking at 1.3% overall in inflation and 1.7 below that if you exclude food and energy. Textbooks agree that if you have too much money chasing too few goods, right, you will have inflation eventually. With a boost in the price of oil, an economic surge, mass fiscal support, we would expect inflation to stabilize and rise going forward. This is an important consideration. Not all inflation is bad, not just for us as consumers, but we need to consider it from the standpoint of our government debt. According to the Treasury Department, every 1% increase in inflation results in $200 billion in additional interest expense per year going forward. So let's shift and talk about some trends that have evolved in the pandemic. We've all spent time talking about these trends, whether it's working from home, education, online groceries, shopping, lack of travel, hotels, and even issues such as privacy. We could spend a lot of time here. The question is whether they're longer term trends or they're just short term fads. And there's three of them that I want to address as they relate more to the markets and financial planning. That is deglobalization, housing, and education. For decades, globalization, or the interconnection of economies, has increased as companies expanded their global chains. The proponents argued free trade would reduce barriers, promote global growth, increase competition, and drive down prices. With that came the criticism of jobs going abroad and increasing risk of our technology being copied or stolen. With this pandemic, we could see these same corporations reduce their reliance on this international connectivity, which will have global effects on different countries and how we do business with them. Here is an example of our pharmaceutical imports, which have grown significantly, as you can see on the left. To the right is our reliance, as an example, on China just for medical supplies. The most notable are antibiotics from China at 97% of our market share, which I highlighted in the box. Below that, ibuprofen at 95% and vitamin C at 90%. As globalization slowly grew over the decades, deglobalization may now do the same. And that effort appears to already be underway. In June, the DFC, of the Development Finance Corporation, was authorized to issue loans to support projects that create, expand, or restore domestic capabilities in response to COVID. And these will be funded by the CARES Act. Second, one very noticeable difference between the recession today versus the global financial crisis is housing. Housing was one of the most affected areas of 2008, yet with no recovery. I personally know I sold my house last year at a 40% loss. We began 2020 with housing inventories at decade-long lows, as you can see here indicated in this circle. Couple that with all-time low in interest rates that we discussed, and increase in demand from the pandemic as individuals and families don't feel geographically tied to their employer, and all of a sudden you have a robust market. Realtor.com this month announced existing home sales were up about 10.5% over last year, the fastest pace since 2006, and that the median price of existing homes has increased by 11%. So shame on me for selling last year. Of course, it remains to be seen if this is a longer trend, but I, for one, am certainly wishing that it will be a longer term trend. I'm going to switch now to education. For all parents like myself, this has certainly been top of mind as students have returned to school, universities, and different capacities with no long-term plan for within the school year. With already high education costs, which I'm showing here, and new technologies available, I think many are questioning the future of what education looks like. The numbers are hard to see, so let me walk through them. The average public college tuition today is in the far right small box, is just under $22,000 for public and $50,000 for private education. Furthermore, if you have a newborn today and you want to plan for their education, it is estimated in the larger box that you will need over $227,000 for a 4-year public education and $517,000 for a private. My family and I are skiers, as Ellen alluded to. My kids race on a team in Vermont. We have already seen families sell their homes and move there full time. We have one friend that found an online education that is solely for athletic kids that will customize their education to their ski training. Just prior to the pandemic, last year, Harvard Business Review published an article, "Does Higher Education Still Prepare for Jobs?" suggesting that employers are looking at factors other than college education, and more time is being spent on some of the soft skills. Permanent or not, there seems to be a clear shift in education. You could foresee a consolidation, a disappearance of lesser known local schools, and possibly top universities gaining more market share, not only on a national, but on a global level. So what types of opportunities might we see coming out of the pandemic? As a financial planning firm, we have a focus on helping our clients, our individuals, and an area that we remain laser focused on are the types of investments that we think we can find opportunities in to achieve their goals. Now, broadly speaking, as we discussed, today's opportunities for investors remains difficult with equity markets at or near all-time highs, or bonds or cash with yields at unprecedented lows. So I'd like to highlight 3 themes that we are focused on today. The first is within the equity markets. Despite the US market experiencing one of the quickest equity rallies and being back at all-time highs, it's important to look under the hood of what created that return. If you do that, you will notice a massive disparity. This chart shows the top 6 companies: Facebook, Apple, Alphabet, Amazon, Netflix, and Microsoft, and their growth as represented in the blue line relative to the rest of the S&P, which is in red. Although the S&P is made up of the 500 largest companies in the US, these 6 companies alone have produced the majority of the return of the S&P, not only for this year, but actually going back further about 5 years. I think it's important to note that the last time a handful of companies made up 20% of the S&P, which is what we're seeing today, it was back in 1999. It was Walmart, Exxon, Cisco, Intel, and GE. The decade following this, they underperformed by about 5% per year to the S&P. We're not suggesting by any means that these companies are bad investments. We love them, but we do think that there is going to be a transition moving forward at some point that we want to be cognizant of. Another way to look at it is based on the barbell, that I'll call it, that we see in equities from a sector standpoint. It appears our emotional biases have come through in this pandemic that have created the loved versus the hated. When you look at this now from a sector standpoint, the loved are the blue bars to the right that have positive returns for the year: information technology, consumer discretionary, communication materials, healthcare, and more recently, consumer staples. The bars to the left are the sectors that remain negative this year, most notable energy, financials, utilities, real estate, and industrials. In fact, the variance of return between the best and worst performing sectors for this year is a staggering 80%. Information technology is up almost 40%, and energy is down over 40%. History is yet again telling us that when you have such a barbell of return, there is opportunity to find dislocation. We believe the selectivity and the understanding of the fundamentals will be the critical in uncovering those opportunities within the equity markets. I talked about income before. I want to circle back on this. There's been a desperate search for income. We have 10,000 baby boomers retiring every day in this country. There's never been more of a need for income or yield as there is today. Despite equities with more risk than bonds in a portfolio, they will continue to be an important consideration for retirees, predominantly due to this income challenge. Note here that the dividend yield on the S&P today, which is in light blue, is double that of the 10-year Treasury in the dark blue. In fact, this is the widest variance we've seen between these two. Investors will have to rely on riskier assets going forward to maintain the same level of income that they have received in the past, or maybe that their parents or grandparents received in the past. And the risk is not just market risk, it's other things like liquidity and credit risk. This will continue to be a challenge given the fact that the Fed has no intent of raising rates, as we talked about, anytime soon. The mindset is going to have to change, and this is incredibly important for retirees to think about when they plan for their retirement and how they're going to manage for this income going forward. We think this is one of the biggest challenges in the industry for the foreseeable future. Lastly is the opportunity within the bond space. As discussed earlier, with yield at such lows, it also requires a further look under the hood in the bond space. And I apologize, there's a lot of information on this page, so I tried to highlight a few things. The page basically highlights a glimpse as to the variance within bonds, whether it's their yield on the left-hand side of the page or income, the disparity of the performance so far this year, which is in the middle of the page, or their risk or correlation to the equity markets, which are on the far right. Traditional bonds are on the top half of the page. As an example, the 10-year, as we mentioned earlier, the 10-year Treasury is at 0.67% in yield, which I highlighted in the circle. We have had a good return this year with almost 13%, but we, again, would believe that that was driven partially by yields moving lower to where they are today, under 1%. And it also highlights their historical negative correlation with the equity markets in red on the upper right circle. It's nice that when the equity markets go south, you want something in your portfolio that can buffer and hopefully move the other way. Bonds have historically been a great place to diversify your portfolio. We also highlight on here, if you look towards the bottom half of the page, other areas of fixed income that may act more like equities. So for example, I highlighted the convertibles and the high yields. You'll notice you get more income, roughly 5 to 6%. But when you move to the far right of the page, you'll notice that the correlations are in black and are 0.89 and 0.73, meaning that when the equity markets move, although these are bonds, they might act more like equities than fixed income. So there is a risk reward in this environment where you can get more yield, but you are going to take on more of that risk that we discussed. Now, we would believe is if you go and you do your due diligence in each of these areas, that you can find, again, these dislocations, and that is something that we are actively doing today for our clients. And that will be an area of opportunity within the fixed income space going forward. In summary, it appears that the worst of the recession is behind us. We've begun a recovery. We've seen unprecedented response from fiscal and monetary policy. We do believe that we'll continue to see some form of that going forward. The markets have had an incredible recovery, and yet investors are again responding with their emotions. We've seen trends in this pandemic that will likely reshape our economy going forward. We have challenges both in the stock and fixed income side, but we do believe that it's a great time to focus not on the broad market, but where we have those dislocations and thus some opportunities from there. Always happy to have a follow-up conversation with anyone that would like to talk about it further. If you need a soundboard for your financial portfolios, my contact information is here. And with that, Ellen, I think we can maybe open it up for questions.
Please put your questions in the chat box.
I've addressed everything. Is that good?
I think so, Julina. Any questions?
It's a lot to cover in a short period of time, I understand.
Okay. Well, thank you very much, Julina, for giving this fascinating presentation this evening. And one question I did have, a person asked, she wants to know whether this is your trends are either a short or long-term trend. The changes will be a fad or a long-term trend.
The trends that we discussed?
Yes.
Yeah, it's a great question. I wish I knew the answer. I think it's going to remain to be unseen at this point. For me personally, the housing and the education, just because I'm so emotionally tied to the two right now. I personally think that we are going to see some longer term trends. I think also, again, just going back to some of the uncertainties, those also may be some trends going forward. Those are certainly some long-term trends that we are going to be talking a lot more about going forward. Not necessarily that we have concerns today about inflation or our debt, but if we don't address it, they're going to be some trends that we're talking about, if that helps.
Another question is, how will the US dollar fare and how will that affect investments?
Yeah, that's a great question. The dollar has been so strong for the last decade. And it's one of the reasons that if you were an investor abroad and owning international securities, it's interesting. It's not that the international markets actually fared much worse than the US. It was that the dollar took away all that gain. So there is a lot of conversation around the dollar going forward. And I think that there's almost there's almost a short-term and a longer-term trend that are playing out here right now. We do think that the longer-term trend is that the dollar will weaken relative to the rest of the nations. However, in the short term, the dollar seems to continue to be the buoy in the marketplace. So, from an investment standpoint, we are looking more at the international space going forward, realizing that it may struggle in the shorter term, but we think over the next decade that if you're an investor, you're going to have a higher return in the international markets than you will in the US, and certainly emerging markets.
Any more questions?
I love the questions.
Going once, going twice? Okay. Thank you all very much for coming this evening. We have a lot of comments from people who say that they enjoyed the presentation and that it was thorough and clear. And the international aspect is very interesting. Great. Thank you all for coming and have a great evening.
Thank you so much.